All right. So let me share my screen. So, all right. So tonight we're doing something that's somewhat related to option pricing theory, but it's actually more from the area of risk management, where the information we need is coming from option pricing theory. So this is let me go over to Brightspace and open up our notes. Okay. Oops.
Good evening, Professor.
Hello. How's it going?
I'm
All right.
good.
I just realized my computer must have rebooted, so now I have to open up everything again. 1 second. So what makes it real kind of aggravating here is I don't know if you have this problem, but I have McAfee for my virus checker, and it really is very aggressive, let's just say. And so for certain websites,
Yeah.
I literally can't open them up unless I turn off the VPN feature. And NYU is one of them. I don't know why, what the problem is. So otherwise it just keeps coming back and saying, sorry, you can't get in there. So I'll get it open. It's fine now.
Uh-huh.
But I took a while. I mean, I didn't know at first. I was like, what's going on here? I had to call the company and it yeah, it was very annoying. But at least now I know what the problem is. So here we go. So this is week 7. And so we're going to look at the Greeks, as they're called. They're a series of risk measures based on option pricing theory. And so first, let's open the notes. Oops, no, that's not what and now this is a spreadsheet that I put together that will illustrate exactly what we're doing so that way we don't have to spend the whole night typing because there's a lot of formulas in here. All right, so let me open everything up. Now, also, by the way, there's no more assignments due this semester. I'm going to be correcting them all in the next week or so, but um, the last one we did, the one with the Black-Scholes model,
Yeah.
um, in here. Oh, there it is. Yeah, session 8, there's a lot of Excel that we'll be doing there. But again, there's not going to be an actual assignment. So we're done with the assignments. I'll get it back to you next week, I think. So tonight we're just going to see how the Greeks work, and we're going to see how they can be implemented in Excel. And of course, we want to understand what they're for and why we use them and what their key properties are. Okay. Let's see. Let's get this going. So this is these are the notes, of course, and then we also have a spreadsheet that we can use to illustrate all of these examples. Here it is. So yeah, we'll go to the slides first because otherwise none of this will make any sense. Yeah, there's a lot going on here, so we'll get to that in a bit. So what exactly are the Greeks? All right, well, first of all, now that we understand the properties of options, we understand trading strategies, we understand the different kinds of options that trade in the marketplace. We have some sense of how they can be used for hedging purposes, but what we can also do with them is manage the risk of our existing portfolios. And in order to do that, though, we need to understand a series of risk measures, which are often referred to as the Greeks, only because the names that they've been given are Greek letters in many cases. I don't know exactly how they came about. In the early days of trading options, I guess somebody on Wall Street thought it would be cool to call them by Greek names, and that convention is still with us. We're only going to be looking at the basic ones. There's actually a very large number of Greeks that are very, very complicated. We're going to look at the basic ones that everybody uses. The others that we won't be covering are meant for much more specialized cases. So the Greeks themselves are these risk measures, which basically are designed to tell us how sensitive an option's price is to changes in the underlying variables, like this asset price, the strike price, the risk-free rate of interest, the volatility, and the time to the maturity date are the most important factors. So we're going to see that, at least for here, the Greeks that we'll be using tonight were taken directly from the Black-Scholes model. Now, it turns out that we could actually derive them from other models as well. In other words, remember last week we were doing the binomial option pricing model, and there is a way that you could calculate the Greeks from the binomial option pricing model, but it's a lot more complicated, to say the least. So for the most part on Wall Street, the Greeks are taken directly from Black-Scholes with, with the understanding that, there's some inaccuracy involved, but they seem to do a very good job. And so traders at these different desks, especially options traders, will every day have a list of these Greeks handed to them so they can see how sensitive their positions are to changes in the underlying variables that are used to price the option. And then we'll see how that can help us decide if I want to hedge a certain exposure, let's say. It's helpful to me to know not only what kind of option I should use, but how many of them I should use, because sometimes it's not just a simple matter of buying a single option to hedge my portfolio. I might need a large number of different options, and I have to understand how that is affecting the risk profile of my portfolio. So this will help us do that. Okay, now, we know from past chapters that the price of an option, whether it's a call or a put, depends on the following factors: the price of the underlying asset, the strike price, the volatility of the underlying asset, the risk-free rate of interest, and the time until the option matures. And we know that most options have maturity dates less than a year in the future. So it turns out that for the most part, as time increases, time until maturity, the options value goes up, because that means there's more time for the value to change, and that works in our favor. Okay. The risk-free interest, it's not maybe quite as obvious what that relationship would be. But remember too, the risk-free rate of interest is simply the yield on a treasury security whose maturity matches that of the option. So if this is a 3-month option, then the risk-free rate would be considered the 3-month treasury bill yield. Now, the volatility is an interesting idea. The volatility is a measure of risk. Okay, it's essentially capturing how much the underlying asset changes over time. The problem with volatility is that it's not something you can directly measure in the marketplace. It has to be derived from a model like Black-Scholes. So it's a very tricky thing to estimate properly, although there are many, many models to help us do that. But it's not something you can directly observe in the marketplace. It is implied by whatever model we're using to price options. So sometimes it's called the implied volatility, to indicate that it is not a historical measure, but it is based on current market conditions. And so essentially it tells us what volatility is consistent with the Black-Scholes prices of our options. But anyway, if any of these changes, of course, the option price will change as well. And sometimes, that makes things very complicated, because what if the volatility goes up and the risk-free rate goes down, and then the time gets, to maturity shrinks? We want to understand how each of these factors individually affects the value of the option, so we can measure the impact of all the factors on the option as well. All right, so now their names, as you'll see in a few minutes, pretty much are all based on Greek letters, and this is how they got to be called the Greeks. Not all of them, though. And the newer ones that were developed later on, mostly they have names that are taken from physics. But the initial set of risk measures that were used were all more or less Greek letters. So they're measures of the sensitivity of an option's price to changes in the underlying variables, of which we already just saw all 5 of these. By the way, I just want to mention here too that the strike price can't change. So really what we're focusing on is the impact on the options price of the change in the asset price, the volatility, the risk-free rate of interest, and the time until the option matures. Okay, so those are the ones we're going to focus on. The strike price is a fixed constant. What you can do, though, with the Greeks is you can't actually say, for example, what happens if the strike price changes, but what you can do is ask a question like this: if I have 2 options that are identical in every way except for the strike price, what should be the difference in their prices? And so the Greeks can help us answer a question like that. All right, well, anyway, why don't we start? Oh, by the way, here are their names. Now, the delta, and over here I've written the equivalent Greek letter. We have delta. Now you've seen delta before. Delta is used throughout math and statistics to represent the change in something. This is the uppercase delta in the Greek alphabet, and it's usually used to represent the change in some variable or other. Then we have gamma. Now this is again the uppercase gamma. And we'll see what that means in a few minutes when we get there. Then we have theta. Now remember, when you took trigonometry in high school, we often use theta to represent angles. Okay. Like if you're taking the sine of 90 degrees, then 90 degrees would be your theta. Here, though, it has a different interpretation. And then we'll skip to the bottom for a second. We have rho at the bottom. You often see rho in statistics used to measure correlation. It doesn't mean that here, though. We'll get to that in a bit. Okay. Now, here's a bit of a snafu. The fourth of these four measures is called, five measures rather, is called Vega. Now, I don't know who chose this name, but Vega is not a Greek letter. It sounds like it could be, but it's not. Vega is actually the name of a star in the constellation Lyra. And so because it doesn't have a Greek letter, what we often see in the literature is that we sometimes see it replaced with lambda, because that way at least there is a symbol we can use to represent it. And very occasionally it's also expressed as kappa. But unfortunately, Vega is not an actual Greek letter. Now, some books will use instead a fancy V, something like that. But again, the Vega is not technically a Greek letter, so it is badly named, but we get it. We understand the Vega, what it means. Oh, how embarrassing, right? So they're almost all Greeks. I guess it was chosen because it's a V and it sounded cool. All right. So now we get to define what these actually mean. Now, in each of these cases, we're going to make a distinction between the Greek that is defined for a call option and the Greek that is defined for a put option. In many cases, the properties are very, very different, although you'll see later on that in some cases, the properties are actually identical to each other for calls and puts. So we'll see which is which. Okay, but for each one, we'll derive a formula and we'll make a note. Does this refer to a call or does it refer to a put? And we'll use a simple measure of letting the subscript tell us which one it is. So this is clearly the call delta. Now, it actually is a ratio. It's the change in the price of the call option divided by the change in the asset price. Now, this notation that we often see used, let me just show you how we often express this. We don't want to always be writing this out in words. Now, this is an interesting symbol. It's also not a Greek letter. So if you remember from when your math travels, you remember that in high school you were told that the slope of a line, let me just throw this into a separate document real fast. Just to explain what this notation is all about. You might remember from your travels, the equation of a straight line, y equals mx plus b. Is it bringing back pleasant memories, I hope? The b is your intercept, and the m is your slope, and that's defined formally as delta y over delta x. Okay, so in other words, if your equation is y equals 3x plus 4, would look something like this. The intercept is here. The slope, which sometimes in high school, sometimes referred to as the rise over the run. It basically tells me if this is 3, that means for each 1 unit increase in X, Y increases by 3 units. So the line is fairly steep. It's positively sloped and it's fairly steep. So now we don't know what the units are without more information. These could be dollars, for example, or it could be pounds, or it could be inches or whatever. So, but what we do know is when X goes up by 1 unit, Y goes up by 3 units and vice versa. In other words, if X goes down by 1 unit, then Y goes down as well. But what I want to point out here, though, is that the slope, this represents a change in X, and this represents a change in Y. So where did this bizarre symbol come from? What is this supposed to mean? Well, it's the same idea, except this only occurs when Y depends on 2 or or more variables. So in other words, in order to make a distinction between the two cases, this, I don't even know if this thing has a name. I'd have to look that up. It looks so much like a Greek letter, but it isn't. So in other words, we reserve that special symbol for the case when Y depends on X, but other variables as well. Whereas for the straight line, that's not the case. Y depends is uniquely determined by X, so we use the Greek letter delta. But when Y depends on other variables as well, we use this symbol. And so that's why it's written in the slides like that, because in that case, we're looking at the price of an option. So you've got the call is a function of S, X, sigma, R, and T. So if I want to describe the change in C due to a change in S, I'm going to use the symbols, this symbol, instead of delta, although they're going to be approximately equal to each other. With this symbol, we assume that all the other variables are held constant. When we allow S to change, the others are fixed. Okay. Otherwise, you kind of mixing together the effects of 2 variables changing, and it's hard to tell how much of the change is coming from one versus the other. So when we identify these sensitivities, as they're called, we're trying to isolate the impact on our dependent variable, which in this case is the call price, from each individual independent variable, one at a time. Okay. So that's the origin of this notation. All the Greeks are done like this. In each case, in the numerator, we have the change in the price of the option. In the denominator, we have the change in one of the variables. Okay, so they're all sensitivities. They all measure the sensitivity or option price to the change in one of the underlying variables, holding all the rest constant. Okay, but you can think of them as this type of slope. It's just that they're multidimensional slopes. Okay, so that's why we use this notation. Oh, maybe I'll put this up here. Just to keep it all together in one place. All right, so let's get back to the slides. So you can see we are going to see this notation throughout the chapter. So And by the way, the other motivation for doing this is because if we use deltas, we could get it confused with this Greek letter delta. So we use this symbol instead. Now, when you stop and think about this, we know that when the asset price goes up, the option price goes up as well. At least the call does. We know that. The question is by how much? And that, of course, depends on a lot of factors. Okay. So just as a quick example, suppose you did the calculations and you discovered that your call's delta is 0.23. And that can be interpreted to mean that if the stock or asset price goes up by $1, the call price will go up by 23 cents. Okay. So in other words, it would be expressed as 0.23, but the way we interpret that is that each $1 increase in the stock price adds 23 cents to the value of the call, but every $1 decrease in the stock price reduces the value of the call by 23 cents. So that would be an example of a delta. All right. Now, by the way, I do want to mention that because of the properties of our option, the delta of a call can never go above 1 and it can never be negative. Okay, so that's what I wrote there is a compact notation that shows delta C must always be between zero and 1. Okay. Now we're going to see a graphical interpretation of what the delta is actually telling us. We're going to go back to this special graph that we've seen before, where I'm going to show you two things at once. We're going to look at the payoff profile to a call option. And then we're going to look at the actual market price. Okay. So hold on 1 second. Okay. So here's the graph that I'm referring to. So the black, this, by the way, this is a call option where the strike is 50. Okay, you can tell because that's where the payoff profile goes from flat to having a slope of 1. Okay, so 50 is the strike price. Now, let's say the stock price is 53. The payoff at that time, if we could exercise the option early, would be $3, of course, because you have the right to buy something for $50, which is selling in the market for $53. So you can see from the graph that at a price of 53, on the bottom line there, the black payoff profile, that the payoff or intrinsic value of this option would be $3. By the way, I just want to remind you, let's add this to the graph. This payoff profile, when we go from 0 to the strike price, has a slope of 0 because it's a horizontal line. After that, the slope goes to 1. Which means that when the stock price goes up by $1, the payoff goes up by $1 and vice versa. When it goes down, the stock price goes down by $1, so does the payoff. Now, the red line, though, is the market price, and the market price is always higher than the payoff until the maturity date of the option. What separates the two is the so-called time value. And in this case, you can see the time value is $4. It's quite a bit, it's actually higher than the intrinsic value. And what that means is that what you're paying for is the strong possibility that the stock price could continue to rise until the maturity date of the option and then put more money in your pocket. So what does this all have to do with delta? Well, it turns out, interestingly enough, that the options delta is nothing but the slope of the market price line. Okay. So in other words, I tried very hard to draw these little tangent lines so you can see them. A tangent line, remember, is a line that touches a curve at exactly one point. And what we care about here is its slope. Okay. The slope, if you notice when the stock price is 40, the slope is very, very small. As we increase the stock price, the slope gets steeper and steeper. And so here it is close to 1. But it can never actually break through 1. It can't go above 1. Okay. In other words, as we saw, because it's not possible for the option to buy a stock to grow more quickly than the stock itself. So the slope of that line is the delta of the option at that stock price. So this number, sorry, this is a mistake. This should be 0 right here. And that slope is the delta. Okay. And it's the same thing up here. The slope is delta. Okay. And so you can see the way that it behaves is that when the option is deeply out of the money, the slope is close to 0. When the option is deeply in the money, the slope is close to 1. When we get to the strike price, right about here, then the slope is going to be very close to 1/2, because we're basically sitting on the fence between the option finishing in the money and out of the money. So slope, it's 50.5, which means that the stock price goes up by $1, we'll make 50 cents on our option. Okay, so as you can see then, as time elapses though, as we get closer and closer to the maturity date, the deltas will be very close to 0 for options that are out of the money and very close to 1 for the options that are in the money. So when we land on the maturity date, it has to be either 0 or 1. Okay, so I'm hoping that gives you a good intuitive feel for what the delta actually refers to. And so, yeah, that's what I was doing here. I was sketching in when the option's out of the money, as it is way down here, the delta is close to 0. When we're right at the money, the delta is right around 1/2. And as it gets closer to 1, the delta converges to 1. And by the way, when we get to that spreadsheet, I can show you by changing some of the assumptions how this is happening. Okay. And yes, here's another example of the same thing. All right, now with a put, now puts are different because puts, of course, benefit from falling prices. So you can imagine if I drew a graph of the payoff to the put and the market price, sign of the delta is going to be very different. So the put delta is bounded between -1 and 0. And that's because when the stock price goes up, the put price goes down. But the pattern is the same. In other words, when the put is out of the money, the delta is close to 0. When the put is at the money, the delta is right around -1/2. And when the put is deeply in the money, the delta is getting very close to -1. Because again, with a put, you're benefiting when the price goes down and you're losing when the price goes up. All right. Now, there's some interesting relationships between the two of them. Let me just jump ahead a little bit. There's some interesting graphs. Oh, all right, they're coming up later that I want you to see. So because of the way they're defined, it turns out that if you know the call delta, you can easily calculate the put delta by simply subtracting 1 from the call delta. So let's say the call delta is 0.3, then the corresponding put delta is 0.3 minus 1, which is negative 0.7. Okay, so they always have to add up like this. Now, how do we calculate the deltas? Good question. So for the original Black-Scholes model, if you remember, let's go back here and review this for a second. The original Black-Scholes model can only price European call options on non-dividend stocks. Put call parity can then be used to price the corresponding European puts. The modified Black-Scholes model, or extended, however you want to look at it, often called the Merton, because Bob Merton did this. Can price European call options on any asset. And again, put call parity can be used to price corresponding European puts. So the formula for calculating delta will depend on what type of asset we're pricing. If it's paying no dividends, we can use the original Black-Scholes model. If it is, we have to use the modified version. So how does that work? Well, it turns out that the delta calculation is actually surprisingly easy, because all we have to do, and this is taken from the Black-Scholes model, by the way, is use the ND1 in the Black-Scholes formula. Well, how do you like that? So all that time it was hiding in there, in the Black-Scholes model, we calculated these ourselves, but we didn't really focus on the idea that ND1 has a special interpretation, which is the delta of the call option. So if let's say that the ND1 is 0.7215, that means that that's the delta of the call, right? So we know that it's going to be between 0 and 1 because it's a probability. So that's not a problem. Okay. Now there's, a lot of math going on behind the scenes, of course. But using the put call parity condition, we can now calculate the delta of the put. And you can go through all the gruesome steps if you want, but ultimately, delta P is delta C minus 1. Or you can think of it instead as ND1 minus 1. Okay, so once you know delta C, it's an easy matter to figure out the delta P by just subtracting 1 from it. Okay. So, yeah. Now we've got an example. Now this is based on an example we did ourselves a while back. You might remember this one. We had a 1-year European call option on XYZ stock, which had a strike price of 50 and a stock price of 52. The risk-free rate was 2%, and the volatility was 30%. So let's go back to let me go open up the Black-Scholes pricing spreadsheets we did last time in week 6. This is Black-Scholes example number 1. This is to refresh our memories. All right, it's gonna take a minute. God, it's really taking its sweet time today. Hmm. Well, I don't know what's going on there. Now, the computer got rebooted this afternoon, so I know that's not the problem. We'll give it a minute and then I'll just delete it and start all over again. All right, I can see that this is not gonna happen. Oh, for Christ's sake. All right, we'll just try it again. It's really aggravating when this happens. It's just like, oh, I'm too stupid to open up. All right. I I'll just go get another copy of it. I always have multiple copies of everything. I don't trust technology one little bit. Yeah, so what was so hard about that? I don't know. I don't know what's going on here. But anyway, this is the same one. Remember, we came up with a call price of $7.63.05. Then we actually did a little test here. ND1 is right here, 0.6359. That is the delta of our call. And that implies that if I add $1 to the stock price, it should add approximately 63.59 cents to the call price. Now we tried it here. I did raise it to 53, and this is the new price. So it didn't go up exactly 63.59, but it went out fairly close. Keep in mind, this is only an approximation, and other factors get involved too, but that's not too bad. The one thing I do want to mention about these Greeks is that it's understood that when you use these Greeks, the changes are supposed to be very, very small. Okay. In other words, like if I let this go up by not a dollar, but like a dime, let's say, and I'll put the new price here. What is that? 7.69675. The predicted difference, according to the delta, is about 63.8 something. And you can see this time it's much closer to the actual difference. So in other words, before when I raised it by a dollar, that was a very large change. And so that's why the delta is less accurate than if I let the change be small. Okay. And now I'll tell you what, I'll show you why this is happening. Let's go back to the graphs for a second in the slides. Oops. This graph about the market price and the payoff and the deltas. The reason why the accuracy is not perfect is because if I allow the stock price to go up by $1, I'm moving up this red curve, and you can see that changes the delta. Okay, so that is one of the reasons why the measure is not as accurate as you might think, because the actual stock price changing doesn't just affect the option price, it affects the slope of the curve. And so that's going to distort the actual change in the price. So, but it does a pretty good job, all right, reasonably good job, even with a relatively large change in the price. Well, anyway, so in this case, this is our actual delta, right? ND1 is the delta, right? If you notice, when I change the stock price, the delta changes too. So we'll see how to. There's a way to help eliminate at least some of the inaccuracy caused by that. We'll get to that in a bit. Anyway, let's see, where were we? Oh, right. So they're telling us here that when we use this example, the delta turned out to be 63.59, which implies that the corresponding delta for the put the delta of the corresponding put would be negative 0.3641, which means that every time the stock price goes up by $1, you would expect the put price to go down by about 36.41 cents. And again, that's because an increase in the stock price is actually reducing the value of the put. Now, if you notice, it's not the same amount. It's a smaller number in absolute terms. And that's because the call is in the money and the put is out of the money. And that affects the delta itself. It not only affects the delta, but how sensitive it is to changes in the stock price. In other words, if you look at this graph very carefully, before we were looking at the deltas based on the slopes of this graph. Let's see. Oh, this one will do. When we're really out of the money, you see how this delta is close to zero, and it doesn't change very much. It would take a huge change in the stock price for the delta to change significantly. But up here, the delta is increasing almost on a one-for-one basis with the stock price. The slope is steeper. So we go from a very flat slope to a slope of about a half, all the way up here to a slope of about 1. So that whether you're in at or out of the money will affect how sensitive the delta itself is to the stock price. All right, now the put, I already mentioned that. Now, what I've done here is based on the same exact example, I went ahead and recalculated the call price. Let's see, what do we have here? What we have here is in the horizontal axis, we have the stock price. On the vertical axis, we have the delta. Now, we haven't seen this before. By recalculating the Black-Scholes price at every one of these values, I can calculate the call deltas. And I actually did that and turned this into a graph. And you can see it's a big S curve. Down here at the low end, when the stock price is low, the slope is very close to zero. But although it can't go below zero. When we get to the strike price, the slope is roughly 1/2. And as we get further and further into the money, the slope gets steeper and steeper, although it eventually flattens out and it gets very, very close to 1. So that's how the delta evolves according to the stock price. When we're deeply out of the money, the delta hardly changes at all. It just sits there right around zero. When we're at the money, it can change dramatically with very small changes in the stock price. And as the stock moves very deeply into the money, or the option moves deeply into the money, the curve flattens out because the delta is getting close to its limit of 1. Now, this will help us understand, what happens to our portfolio as the market changes. And by the way, this also shows us why hedging can be very important, but it depends on how deeply the option is in, at, or out of the money. Okay. Now, what about the put delta? What does its curve look like? All right. Well, let me show it to you. And you're going to look at it and say, wait a minute, it looks kind of familiar. Wait a minute, it's the same shape. The only difference is that this axis runs from 0 to 1. And this axis ranges from 0 down to -1. But the curve is exactly the same. The slope is exactly the same, except for being negative. The magnitudes are the same. It's the signs that are different. Ah. So you can see. Now, the reason why they look like this is because, as we saw earlier, delta P is delta C minus 1. So they're only different by a constant. And that's why their sensitivities are the same for both of them. Okay. The slopes, in other words, these curves are identical to each other except for their signs. Interesting. Now, before I mention that, the way we calculate the Greeks depends on whether we're using the original Black-Scholes model or the more advanced Merton model. If we are using the more advanced Merton model, we have to make a couple of changes. Okay, so in other words, remember Q is the continuously compounded dividend yield. And so if we are using Merton's model, we have this extra term in our calculation of delta C and delta P. And I just, at the top, I made a note that unless the yield is really huge, e to the minus qt is only slightly less than 1. So in other words, it doesn't make an enormous amount of difference between the two formulas. But we want to be as accurate as we can. So when we're using the Mertens model, we certainly want to include every important detail. All right. So now here's an interesting side note. The delta can be applied to other assets besides options. It's just that normally this is where we see them. With a forward contract, it turns out the delta for a long forward contract is always exactly equal to 1. It never changes. Remember, this is the one where you can't walk away from the whole thing. You're committed to paying for K dollars for this contract or this asset. So the delta here is exactly 1. And for the short position, you'll probably guess it'll be -1. Okay. And that's because, in other words, when S, in the first case, when S rises by $1, the long forward position rises by $1, no matter what's going on in the market. It's always 1 to 1. With the short position, it's just the other way around. Because with a short position, a higher stock price lowers the forward price by $1. Right? So this is how we determine the payoff to a long forward position. And the short is this one. So the delta is -1, which means an increase of $1 by the stock price lowers the value of the short forward position by $1. Now, if you want to get involved with the math, there are technical reasons for this, but the logic is that the change in the forward position has to be matched exactly by the change in this asset price. Now, the reason why we may want to look at the deltas of other types of securities is because when we are hedging our position, what we would like to do in order to make our position as safe as possible, we would like the delta of our portfolio to be as low as possible. So, and in fact, if we want it to be completely risk-free, then what we would need is to lower the delta to 0. Because if it is 0, that means no matter what happens to the asset price, the position of our portfolio will be exactly the same. Okay, so we're coming up on that in a bit, but I just want to mention that in advance. Often when we're hedging a position, what we're really doing is trying to see how low we can get the delta. So if you know the deltas of your assets and the deltas of your hedging instruments, that will make it a lot easier for you to figure out a good strategy. Okay, so now the portfolio delta. So we have the delta for a call, we have the delta for a put, we have the delta for a forward contract. And by the way, incidentally, the delta of the underlying asset is just one, +1. Okay, in other words, if my stock price goes up by $1, then the value of the position goes up by $1. It has to. So you can see hedging with a forward contract would be a breeze because let's say, for example, we have a portfolio of 100 stocks, or let's say 100 shares of Apple stock. Total delta of this portfolio is 100 times 1, which is just 100. If we take a short position in a forward contract written on 100 shares, the delta of the contract will be 100 times -1. And so you can see what's going to happen is by buying or entering into this forward position, the total delta is 100 minus 100, which is just 0. And so that means the portfolio is now risk-free. Okay, but on the other hand, now, of course, the drawback to that is that I can never make any money. I mean, no matter what happens to the Apple stock, the forward contract will move in the opposite direction, and so my position will be 0. Now, so you're wondering, why would somebody do this? Well, imagine that the markets are in a bit of turmoil, and I'm worried about what's going on, but I don't want to sell my position either. So what I could do is temporarily create what's called a risk neutral portfolio, or delta neutral portfolio. And just for the time being, at least, set it equal to 0. And then when I'm more confident about the future of Apple stock, I can go ahead and get rid of those forward positions. And what's left is my Apple stock. Okay, so I just want to mention that here, a portfolio with a delta of 0 is said to be delta neutral or delta neutral, which means that the portfolio has no risk. Okay. So that may or may not be our goal. I mean, we may not necessarily want to hedge all of our risk away because that also hedges away all of our potential return. But like I said, there could be temporary periods where you're very concerned about the markets, but you really don't want to unload your stocks either. So what you can do is you can just go in and just get rid of all the risk by setting up the right position in forward contracts, or we could have also used options. For example, suppose that you decide to hedge this portfolio with puts. Let's say, suppose each put has a delta of negative 0.5. And again, now suppose that each option is written on 100 shares of stock. This means that a single put has a delta of negative 0.5 times 100, which is negative 50. The portfolio of stocks has a delta of 100 times 1, which is 100. So if I buy a put for my portfolio, I'm not getting rid of all of the risk, am I? Okay. So in other words, if I bought portfolio delta will be 100 minus 50, which is 50. So there's still some risk to create a delta neutral portfolio. It would be necessary to buy two puts because the delta of two puts would be 2 times negative 50. It was negative 100. And portfolio delta would become 100 minus 100, which is 0. So in other words, you see how the delta itself helped us decide or realize that if we want to get rid of all of our risk, one put simply won't do it. We needed two puts. And the way we were able to figure that out is through the delta. So you can see, now of course, these are extremely simple examples, but still you get the idea. All right. And by the way, I may have mentioned this before, but with equity options, they tend to be written on 100 shares rather than just one. I think it's the same thing with gold. A single call option on gold would be for 100 ounces. Anyway, now the beauty of portfolio delta is that you're basically just adding up all the assets in your portfolio. You're adding up all the deltas in your portfolio. So in the whole book, he uses pi to represent portfolio. So the delta of the entire portfolio is what we call a weighted average of the deltas in the portfolio, weighted by the value of the asset. So it looks like I do have an example. Good. All right, let me show you quickly how this would work algebraically. So here's a case where we have, oh, sorry, are you caught up? By the way, you may have seen the symbol before. This is the Greek letter sigma, but it's being used here to represent what's called the summation operator, which means it's telling me to add something up. Okay. So let me just give you a very quick example of that. You had something like this. This tells me that I've got x's that are indexed from 1 to n. And you can tell by looking at the index here. And that means just simply add them up. So for this one, you would have W1, delta 1, time, plus rather, W2, delta 2, so you're taking every asset in your portfolio, you're multiplying it by the W. By the way, in this context, the W is the proportion of the value of the portfolio invested in asset WI or asset I. And by the way, these weights can actually be negative if you have short positions in your portfolio. Like if I have short future forward contract, then my weight would actually be negative. But anyway, so this is the thing is this is a very simple measure. You're just adding up the weighted averages of all of your assets deltas, and you have your portfolio delta. Okay, the other measures are maybe not necessarily quite as simple as this. The other Greeks, I mean. So let's look at a quick example. We have a portfolio which consists of $100 worth of StockX and $50 worth of put options whose delta is -0.5. The portfolio delta must therefore be calculated as follows. So the stock is worth $100, the put is worth 50, which means the portfolio is worth 150. Okay, so let's make a note up here somewhere. So that implies that 1/3 of my portfolio is invested in the put and 2/3 is invested in the stock. So think of this as W1, let's say, and this is W2. The deltas are -0.5 and 1. So using that formula we saw before, a third times -0.5 plus 2/3 times 1, and that ultimately adds up to 0.5. So if the stock price goes up by $1, the entire portfolio will gain in value by 50 cents. Okay, that's how we interpret this. Without the put, every $1 increase in the stock price would add, of course, $1 to the portfolio, and vice versa. Now, if we're not satisfied with this, if we think it's still too risky, all we would have to do is buy another put. Okay. If we think it's not risky enough, we could sell the put and make the delta even higher. All right, so you start to get a sense of how we can use options and also forwards, for that matter, to figure out how to manage our risk. In other words, we want it to be at a level which is consistent with what we call our risk tolerance. All right, now if you're very nervous, now let's say that this is a hedge fund where risk is what they live for. You probably will want your deltas to be pretty high. You're trying to gamble and make money if you guess correctly. If you're, let's say, a pension fund or an insurance company, you better not have a lot of risk in your portfolio. So you can see that if we see this delta number, and we decide that it's really unacceptably high, then we might decide to do something about it. We may not be able to easily sell our assets, but we can certainly change the quantity of puts that we're holding. That would be easy. Okay. All right. So that would be a good example of how you can manage the risk of your portfolio with either options or forwards. Nice. All right. Now here, I've already mentioned this a couple of times, the concept of delta neutral. Sometimes our job is to figure out how many shares of a derivative we need to result in a delta neutral portfolio. Okay. Again, that would be a case where we're trying to eliminate all of our risk, possibly for a short period of time, because we're nervous about where the market is going. All right. Now, there are other Greeks that we have to visit too. We don't want to ignore them. And so actually, let's go back to the list that we started out with, so you can see where this is going. So the delta, as you can probably guess, is by far the most important of the Greeks. Any rudimentary trading strategy is going to involve delta. I mean, that it's just, we're just trying to make sure that the sensitivity of our portfolio is not too high or too low for our liking. But these other ones are also potentially very useful. This one, for example, number 2 is gamma. Now, gamma is a different case because the gamma tells me, let's get back here. This tells me the sensitivity of the delta to changes in the asset price. If you're familiar with calculus, the delta is actually the first derivative of the Black-Scholes model, call price or option price, I should say, with respect to the asset price. The gamma is a little different because remember I showed you before with that graph. Let's quickly reproduce this graph right here. Let's say red is the market price. And the deltas of the stock depend on where we are along this curve. So the little tangent lines, the slopes of these tangent lines are the deltas of the option. And you can see they depend very heavily on the actual level of S. So down here, when we're out of the money, the call delta is very low. When we're at the money here, the call delta is close to a half. And when we move into the money up here, the call delta is close to 1. So here where I said low, let's change that to close to 0. So what is the gamma doing? The gamma is measuring how much the delta changes as the stock price changes. All right, so in other words, we can see here for ourselves that as we go from left to right, the stock price is increasing and so is the delta, for a call, that is. Okay. So we want to know how quickly is this happening? Oh, formally, gamma rather, is defined as the change in the call delta with respect to this asset price. Now, I do want to mention one important detail here. Let's go back to these graphs we had earlier, which represented the relationship between delta and the stock price. So that means that the gamma is the slope of this curve, because this curve shows me the relationship between the delta and the stock price. So therefore, these little tangent lines represent the gammas of the option at these different stock prices. Now, two important consequences come from this. Number one, the gamma is always positive. There's no change in the stock price that can cause the delta to get smaller. And number two, the gamma reaches its maximum value when the option is at the money, meaning right here. So you won't be too shocked when you see the curve that shows me the relationship between gamma and the stock price. Are you ready? Do not be surprised, because oh no, what happened? Oh, here it comes. Here it is. This is the gamma. If you notice, no matter where we're looking, it's positive, and the strike price here is 50. So the peak is right around here. The numbers are, by the way, are very, very small. If you look at the vertical axis, the highest value here is something like 0.03. So the gamma is not a particularly large number, but it does help us understand how sensitive our portfolio's delta is to changes in the market, the stock price in this case. That matters if you're concerned that, let's say you set up a delta neutral portfolio. If the market changes enough, your portfolio will no longer be delta neutral, because the deltas will drift away from where they are now. And so this will help us understand how likely that is to happen. So in an extremely volatile market, gammas become an extremely important component of our hedging strategies, because they help us understand if maybe it's time to change the number of options that we're holding. Okay. Wow, that was interesting. So it's kind of a secondary measure. It's not absolutely necessary to use gamma to develop a hedging strategy. It's just a way of helping us understand how often our position may have to be rebalanced, let's say. But it does provide us with additional information, and so we're not going to neglect it either. But it isn't really what is important as the delta. The delta is absolutely the most important of all the Greeks. This one is like basically a way of helping us keep an eye on the delta and make sure it doesn't change too quickly. So now here's an interesting twist. Remember I showed you that the gamma is the slope of this curve that ties together, that calls delta with the stock price. But directly below it, we saw the same curve for the put. It has all negatives, but it's the same exact shape. So in other words, the slopes of the two curves are the same. And so because of that, no matter what the stock price is, the gamma will be the same for calls and puts. You can see because of the shape. Remember, the gamma is the slope of this curve. The slopes are identical, aren't they? In other words, in both cases, as S goes up, so does the delta. In this case, it becomes less negative, but that's the same thing as going up. So the result of that is that we don't need to have a separate model for put gammas because the two are always going to be the same. So while, yes, of course, we can formally define the put gamma to be the change in the put delta over the change in the asset price, it turns out that these are the same for each function. So in other words, the call and the put that are identical. By the way, this is assuming that we're talking about two options that are identical in every way, except that one is a call and one is a put. So in other words, if you notice this graph that I showed you, it doesn't actually say call or put on it, does it? This applies to both. So we don't need to make a distinction here for between the gamma of a call and the gamma of a put. As long as the two are identical in every other way, the two gammas will be equal. Wow. Well, that was fun. I think, yeah, well, here's the formulas. Um, by the way, at some point tonight, we're going to go jump ahead to this spreadsheet and we're going to see the calculations being done. Here they are. So the formula that we're using is this one for the gammas. You can see it looks fairly simple. It's based, again, directly on the Black-Scholes model. The only thing that's different here is this. Let me just show you a little diagram here. We went over this last time. When you've identified D1 from the Black-Scholes model, N of D1 is the entire area below that point under the curve. It's a probability. You notice how here it's not N but N prime. This is Hull's notation. This is interpreted a little bit differently. What this is telling me is when I'm at point D1, how high is this curve? Now, the importance of that is that what it's basically telling me is how much does the probability change as I move away from D1. So it's basically, you can think of it as the sensitivity of the delta to changes in the asset price. All right, now sometimes the gamma is used to make our portfolio not just delta neutral, but gamma neutral, which means it's really safe because now if it's both, it means that not only does the stock price not affect our portfolio anymore, but the stock price can't affect the delta either. So sometimes this is exactly what we're aiming for, not just delta neutral, which means small changes in the stock price won't affect the portfolio value. But it also, in this case, if it's also gamma neutral, it means that there will be no impact from the market on our deltas. So if we are currently delta neutral, we'll stay delta neutral unless there's an enormous change in the market of some kind. But it's very complicated. We're not going to be able to do this right now. Getting it to both delta and gamma neutral is a very complex process, and it requires us to use at least two different hedging instruments. And then it ends up involving solving simultaneous equations. And so let's just say it gets very messy in a hurry. All right, so we won't pursue that any further. Just be aware that it is possible as a trading strategy to completely get rid of all your risk by trying to make your portfolio simultaneously delta neutral and gamma neutral. Okay. And by the way, in the spreadsheet that I mentioned earlier, using that Black-Scholes example we had earlier, everything is the same up to this point. And so this is just that first Black-Scholes example. But down here, I've specifically labeled ND1 as the call delta, and then that -1 is the put delta. The gammas, as you can see, here's the formula over here, are calculated, and you notice they're identical to each other as they should be. Okay. Oh, here it is. I did explain that in my spreadsheet. Okay, great. Now, the next one on our list is theta. Now, theta, just a quick reminder as we get into this topic, that as time evolves, the spread between the market price of an option and the intrinsic or payoff value gets smaller and smaller. Oops, what happened? So let's say this is our market price. Oh, no, I better fix that. That's a little too much. So let's say this red line represents the market price 3 months prior to maturity, meaning that this is 3 months before the option expires. And so if the stock price is here, slightly in the money, here's the intrinsic value, the payoff. But the market price is way up here somewhere. So this spread is called the time value. If nothing else changes except the time elapses, let's say the same thing, market price 1 month in advance. Well, what's happened here is the market price has declined, but the payoff hasn't. Okay. So after 2 months, it's at value because the stock price hasn't changed. But the time value is lower. So the total price is, of course, lower too. All right. So yeah, we went from all the way up to red down to just green. Okay. So theta, what the theta is doing here is this. Theta measures how much market value, time value is lost for as as a result of um, time to maturity decreasing. All right, so in other words, as time to maturity gets smaller, we want to know how much of the time value of the option is declining. Or actually, it might be easier to write it like this: as time evolves, which of course it does. It never stops evolving. So in other words, if I want to know how much time value did it lose as a result of another 2 months going by, that's what the theta is for. Okay. And so, you have a portfolio where you're not really trading in the assets very often. You just want to know, if I just hang on to this portfolio, what's going to happen to the value of these options that I'm holding. And so that's what this is all about. So formally, it's simply the change in the call price. In this case, we'll let T represent the time to maturity. Now, for this one, there is a distinction made between the call and the put. They're not identical to each other. Okay, they're both negative, but they're not the same values. Oh, this is a typo. I didn't even notice that. So I've got a couple of graphs here. Now, the formula for calculating this is an absolute nightmare. Look at this thing. That's because time shows up multiple times in the Black-Scholes model. So the formula is obviously very, very complicated. So for our example, here I've got it right here for you. For the call, it's negative 3.43, and for oh, by the way, this number that you're seeing here is per year. In order to convert it into a daily amount, the convention is to divide this by 252. Why 252? Because we're assuming that there's only 252 trading days in the year, and that the options will not change in value over the weekend, let's say, or over holidays. So it's a common convention when in the markets, when converting from annual to daily or any other types of results, we scale it by the number of days, in this case, 252. So what this is saying here is that each trading day, I should say, option loses about 1.365 cents of time value, which over a year would work out to about $3.44. Now, I did the same thing for the call, and I ended up with 254, which worked out to almost exactly a penny every trading day in loss of time value. So this is for the put, the corresponding put. We call that theta P. Now, where do you see these graphs, by the way? The graphs are designed to show us the relationship between theta and the stock price. So for the call, it looks like this. And you notice it's kind of like an upside down gamma. The sensitivity to time is maximized when we're at the money. Then it falls off as we move into the money. And it really falls off sharply when we're out of the money. But it's always negative. All right. Now the put is not going to be identical to this, although you'll notice something interesting about it. Are you ready to see the put? So this is the call. This is the put. Oh, look at that. They're basically, if you can imagine, like one has been twisted around or rotated to the left. So now, although it peaks out right around the strike, it falls off more rapidly down here where we're in the money than over here when we're out of the. Okay. And again, this formula is slightly different if we're using the Merton model. You see there's some cues hiding in here. It's not going to make a huge difference, but if we do have a dividend yield, we want to, of course, go ahead and incorporate it. But you can see there's cues all over the place here. This is really a mess, this formula. Not only that, but we got these negative D1s and D2s. This is quite a challenging little formula, to say the least. So, yeah, why don't we go back and visit our spreadsheet? I think it would be interesting to see how that works. Okay, so yeah, here it is. So, oh, that's right. That's what got this discussion started. The actual value of the theta is this number here, but on a daily basis, it's we're losing about 1.3 cents worth of time value every day that goes by. Whereas with a put, it's just under 1 cent. Okay. Now, behind the scenes, I mean, if you look at the formulas, God, look at this formula. This is what I had to do. Hold on. Look at that catastrophe. But that's the formula that I just showed you before on the spread in the slides. But that is how it's done. By the way, here's an interesting side note. I've been reliably informed by people who work on Wall Street that because everyone understands that the thetas are negative, if you were to go to a brokerage house that offers, an investment advice and get some research reports, you discover that these numbers are often quoted as positive numbers because, negative numbers confuse people. So, if you get a printout of all these Greeks, you might look at it and say, well, why are the thetas positive? That's just because by convention, they often just show them as positive, even though we all understood that they're clearly negative. Wow. Now, let's go back and look at our list from the beginning. By the way, before I completely forget about it, you may not be aware of it, but sometimes Wikipedia, it has a mixed reputation, but for certain things, it's actually pretty good. It tends to be very strong in math and statistics. And here, um, if you find their article about the Greeks, you have to be more specific, I bet. Um, Well, Investopedia, of course, is like the gold standard for finance. You can really count on what they have. But and they do have a list. They have a nice long discussion here about what these Greeks represent. And look at all these links. Like if you're not sure what delta neutral means, for example, or if you don't know what in the money means, all these wonderful links are here. And they give you a pretty nice discussion about, like, for example, theta, as we just saw, represents the rate of change between the option price and time, or sometimes it's called time sensitivity or even time decay. Theta indicates how much its price would decrease as the time to expiration decreases, all other things being equal. Um, Gamma, they have their own discussion here, but what I discovered, though, and here's the other ones that we're about to get to. Now, they do have a brief mention here of some of the other ones. The names, by the way, as you get to the newer ones, the names get progressively more bizarre. These often are, like higher order derivatives, and they're used for only incredibly specialized circumstances that might not even be relevant if you have a simple portfolio, let's say stocks and options. These are for much more complicated securities. But I know that there is an article in here in Wikipedia where they just have a nice little table that summarizes them all. Maybe I can find it, maybe I can't, but I wanted, if it's there. But yes, you can totally rely on Wikipedia, Investopedia. Wikipedia, maybe not. Now, this one is a little, this one just looks at a couple of the specific, more complex ones, Vanna and Volga. Who chose these names? Why didn't they just keep using Greek letters? Uh, anyway, so let's not waste our time with this anymore. But they have you can find a good article somewhere in here about these if you look hard enough. But if you're not sure, always start with Investopedia. Anyway, so in our list of Greeks that we're going to cover, next in the list is where is that list? Here it is. Now we're ready for the one that isn't really a Greek letter. Okay, the one that is bizarrely named either Vega or sometimes it's written as Lambda or sometimes even Kappa. What is this one all about? Well, the reason why they insisted on using a V there for Vega is because this one explains to us how an options price is affected by volatility. Now, I just want to mention here that volatility always benefits an option, regardless of whether it's a call or a put, whether it's in the money, out of the money, whatever the case may be. More volatility is always good news for options. If you own options, you want to see a lot of volatility. And that's because of the imbalance between potential gains and potential losses. Anything as an option holder, anything that adds both to the probability of a high gain or high loss, it benefits you more on average because when you have a gain, you capture the gains directly. When you have a loss, say you're already out of the money, you can't get your value is zero, no matter how deeply out of the money you are. So there's an imbalance between gains and losses, and that's why volatility on balance is helpful to options. So let's take a look at it. Let's see. First we need a formula. Here it is. The Vega is the sensitivity. And did you notice in that Wikipedia article, in several cases, they're using this really fancy V, given that there's no Greek letter for Vega, they just replace it with a fancy V. But in here, I think I used, or maybe I didn't use any. I just use English, it looks like. Oh no, I'm using the lambdas. That's right. Okay. So this is Vega. Fancy V. And it represents the sensitivity of the call to volatility, which is measured, represented by the Greek letter sigma, which often is used to represent the standard deviation. In this context, it refers to specifically the standard deviations of the returns to a stock, not the price, but the returns. So in other words, if you wanted to estimate the stock's volatility, you could get a time series of prices, put it into Excel, and then you would calculate the rates of return, and then you would calculate the standard deviation of those rates of return, and then you'd have your volatility. The Vega so fancy V or lambda, which I used in the slides, as you can probably imagine, is the sensitivity of the put price to the volatility. Now, here's an interesting twist. Let me throw this in here real fast. As with the gamma, the vega of a call and a put and of course, and it's understood we're talking about with the same asset, underlying asset, strike price, and time to maturity are the same, are identical, or equal. Okay, so no matter what options we're looking at, what do you know? Just like with the gamma, these are always equal to each other. So we don't need to make a distinction between them. We don't need a separate model like we do for theta, let's say, or for delta. Okay. Now here's the formula. It looks really, really simple, and it is. I mean, if you look in my spreadsheet, I do, of course, have calculations for call vega and put vega. By the way, the interpretation of this is a little, maybe not what you're expecting. What this tells me is, let's say we come up with 1953. Here it is. 1953, the way we interpret that is a little different. It means that if there's a 1% increase in the volatility, then the price goes up by 1% of 1953, meaning in this case, a 1% increase in volatility adds about 19.53 cents to the price of either a call or a put. So yeah, it's a little different than the others because volatility is measured in terms of percentages per year, whereas the others are, well, the delta is dollars. The gamma is actually the slope. So it's just pure units. The theta is measured in dollars. This one would also be in dollars. Sorry, this one is in the impact of a percentage change in the volatility on the dollar price of an option. Now, like the gamma, also like the gamma, the vega is always positive. Okay. And its value depends on the moneyness of the option. So when I show you the graph, you're going to say, wait a minute, did you accidentally show us the gamma again? Oh, wait a minute. Boy, that does look awfully like the gamma, doesn't it? It sure does. It peaks out where the strike price is, then it falls off very quickly where the option moves into the money and out of the money. But by the way, you know how you can tell the difference? If you look at the gamma graph on the vertical axis, those numbers are very, very, very small. They're all fractions of one. Whereas these Vega numbers are actually quite large. You can see they go here all the way from 0 up to 20. That really is the main difference between the two graphs. Now, somewhere along here, yeah, we have the formula here, but again, like we've been doing all along, if we are using the Merton model because the stock or the asset has some kind of a cash flow to the owner, we do have to modify the calculation slightly. And so you can see the differences here. If we're using the Merton model, then we need to add this term to the formula, but it's not that complicated. Not really. It's, it's like e to the minus qt is it's so close to one that you might not even notice the difference. Okay, well, that's interesting. Now, by the way, I do want to mention, I don't have the graphs in here, but these values will actually change over time because of the way the price of the option converges to the payoff over time. If I have one of these graphs for the Vega, for example, it might look very different next week or next month as we get close to the maturity date of the option. But at any given point in time, this is what the graph is going to look like. So there's our Vega. And you can see, again, like the gamma, it's the same for calls and puts. It's always positive. And it reaches its maximum value when the option is at the money. And of course, the option could be a call or a put. Because that's when the value of an option is most sensitive. Because like I said before, when you're right at the money, you're kind of sitting on the fence between finishing in the money and out of the money. So the impact of changes in market prices will be greatest on options that are right at the money. Okay. Options that are already in the money will be affected, but not as much. And the ones that are out of the money, same thing. Their value is very low and it won't change very much without a dramatic change in market conditions. All right. And so, yeah, so they're here. By the way, if you want to look carefully at this later on, what I did here is I did some experimenting where I used the Greeks that I calculated and made changes to the stock price to compare what changes should have happened according to the Greeks and what changes actually did happen. And you can see they're not identical, but they're awfully, awfully close. Especially some of these are really almost right on, like the Vegas are almost perfect. Where are they? Well, they're all pretty accurate. So you can see I went through and calculated based on these results, the predicted and actual deltas. The delta maybe is the one that seems to be the most off, but even then it's not a very big difference. So you can see these are very helpful measures for this reason. Wow. All right. So By the way, I don't think this is gonna take up until 9 o'clock. Would you rather have a break and then come back and do the rest of this, or would you rather finish early without a break?
No, we could continue.
All right, yeah, because we're getting close to the end here, because you can see we're running out of Greeks. So rather than having a break in the middle, why don't we just keep going until it's done? And worst that can happen is you can go to sleep a little earlier than usual. Okay, all right, yeah, because this one isn't going to take up the whole night. Some of them, there's so much material, you don't know what to do with it all, but this one is fairly compact. But it's all right. So that means there's really only one Greek left that we need to consider. And like I said before, there are plenty of others, but they're very, very specialized. And so here we just want to focus on the basic ones. And so the last one is this Greek letter rho. If you've had any statistics background, you know that it is usually used to represent correlation. Okay, here, the reason why they chose rho is because it is the equivalent of R in the Roman alphabet, and it stands for the sensitivity of the options price to changes in the risk-free rate of interest. Now, this one would be normally considered basically the least important of the Greeks, because the reality is interest rates simply don't change that quickly compared to these other measures. Like the stock price could bounce around all over the place. Time evolves at a certain rate. Time, fine. Volatility can change very dramatically over time. Interest rates are pretty stable for the most part. So the rho, while it's nice to have it, it's probably the least important of all these Greeks. Okay, unless you're in a very strange interest rate environment where the rates are bouncing around all over the place, but you don't see that very often. You're much more likely to see the volatilities bounce around when the market is in turmoil. In fact, I think, just as a side note, I think I may have showed this to you one night. There exists an index, which was created maybe 30 years ago, called the VIX, which stands for Volatility Index. And it's constructed from the volatilities of Standard & Poor's 500 options, I believe. And so what this tells me, if you look at this graph, this refers to the volatility of these options over time. And what tends to happen is when things are kind of rough in the markets, these will start to spike up. When things are going well in the markets, these volatilities tend to be very stable. We can see they can change very dramatically in fairly short periods of time. In fact, I think you'll agree that this looks like an EKG, doesn't it? I don't know if this was my heart rate, I'm not sure if I'd be happy right now. It's just all over the place. It's like up and down and up and down and up and down, up and down, up and down. All right. So anyway, but if, I'm not quite sure what happened here. What happened last August that made the markets nervous? I don't remember. Now, of course, it went to the roof during the COVID, way over here. There it is. This is the COVID. Look what happened. It went through the roof, but that's because everyone was nervous. During more, now look over here, we had a very nice little time here. Look at how low the volatilities are. Then, whoa, it goes up and it goes down and it spikes up during international turmoil. But anyway, so this gives you a sense of how quickly volatilities can change over time. Whereas interest rates, like if I ask Fred for the, I don't know, let's say the 10-year Treasury bill note yield. I don't think you'll see it bouncing around like this. All right, it's offering me 1. Let's take 1. All right, well, I don't know. It's kind of volatile, but not nearly. I mean, yeah, the Fed, remember here, the Fed raised rates like crazy after the COVID started to end. But basically, you can see, except for rare cases like that, interest rates tend to be fairly stable. This is the COVID. Don't even look at the COVID. It doesn't count. All the times before that, I don't know. If you look at a big enough picture, I guess they do bounce around, but still not as much, I think, as volatilities. But anyway, so that's why the rho is maybe not quite as important as the other Greeks. So rho represents how sensitive is my option price to changes in interest rates, specifically the yields of treasury securities, or in other words, the so-called risk-free rate of interest. How is it calculated? And how does it behave? Okay, where is it? All right, so it's a change. And by the way, in this case, it's not the same for calls and puts. In fact, not only is it not the same, but the two have opposite signs, just like deltas. Deltas have different signs for calls and puts. The same thing is true here. So the call row is always positive. So in other words, higher interest rates are beneficial to the owner of a call. And you'll see in a second that for a put, it's the other way around. All right, so in the next slide, we have delta C, a P rather, negative. So the sensitivity of the put to interest rate changes is the opposite. In other words, when rates go up, put values go down and vice versa. Now, the formulas are very straightforward. You'll see them in the spreadsheet. So if you really are interested in this, you can go here and look at the formulas. They're just taken straight out of Hull's book. And you can see, as we predicted, the call row is positive 25 or so. The put row is negative 23 something. So this one also has an unusual interpretation. So let's say for the call, it's 25.43. That means if the risk-free rate goes up 1%, the call price goes up by 1% of that 25.43, which is 25.43 cents. Okay. And of course, when we look at the row for the put, which is negative, it means the opposite. Okay. In other words, this one means that if the risk-free rate rises, by 1%, the put price falls by 1% of 23.58, which would be about 23 cents, 24 cents. Now you'll find these graphs interesting. What I've got here is the graph of the row versus the stock price. And when you see these graphs, you're going to say, wait a minute, they look awfully familiar. In fact, well, we'll see in a second. They're not very different than what we saw with calls and puts. I mean, deltas rather. This is what the row looks like compared with the stock price. So here's this, we're right at the money. So except for the fact that these numbers are actually quite large, much larger than the call delta, this graph does look a lot like the call delta, doesn't it? It's an S curve. Interesting. I think that's very strange, but there it is. And then for the put, it's the same, except that these are negatives. What do you know? Okay. Wow, that's interesting. Now, once again, I mean, now, by the way, here's an interesting twist. In all the other Greeks, if we were using the Merton model, because the asset has some kind of cash flow, we had to adapt our model to take that into account. This is the only one where the calculation is not affected by the existence of a dividend yield. In other words, you do not ever have to adjust the row formula if there is a dividend yield. The others you do. This is the only exception. All right. Now, I just to be on the safe, I just thought you'd find it interesting to put together a little table. Um, I think we mentioned this once before. The thetas, there's a couple of very bizarre exceptions to the thetas, but other than that, these are almost always negative, meaning that when time elapses, the price of an option declines. Now, let's go back and look at our spreadsheet. And like I said, over here on the right, we have all these values that I calculated. So you can compare, based on these Greek measures, what is the relationship between what Greeks would predict and what actually happened when I went up here and changed the actual stock price, or in the other cases, the sigma or R, or whatever the case may be. So in other words, because it's set up in Excel, it's easy to calculate the impact of a change in any of these variables. I can check the stock price by simply changing this to 53, let's say, or I could change the risk-free rate of interest to 3% and see what happens to the price. And so I did exactly that in all these cases, and this is what I came up with. And you can see these numbers. Well, here's one that's a little bit off, but for the most part, they're awfully, awfully close. And it turns out the smaller the change in the asset or the variable, the more accurate these Greeks will be. Okay, so the Greeks were realistically will be more accurate when changes in the underlying variables are relatively small. And that's because for the most part, they're really approximations. Okay, the formulas, if the formulas would be a lot worse if we weren't allowing ourselves to approximate them. But so for the most part, these will be very accurate for small changes. For larger changes, then we'll have a problem on our hands. But they'll work very well for small changes in these market variables. Let's see, what else is here? Yeah, these graphs, you've already kind of seen all of these. So, like I was saying, that's kind of it for the Greeks. So, sadly enough, now remember, there's no assignment this week or next week either. So I guess we're done. It's kind of disappointing, but some topics don't take as long as others to cover. So this is our discussion about the Greeks. And again, remember, these are risk measures, helping us understand how to manage the risk of our portfolios. And So next week, we're going to be introducing a framework for measuring risk called value at risk. And we're going to see how options can be used to reduce the value at risk of a portfolio in case we're very concerned about how much risk is involved. So that'll be something else to look forward to. All right, so I guess I'll just have to wish you a good night then. All right. So I'll see you all next week, where we'll talk about the value at risk framework and how we use how it is used to help us understand how to measure and manage our risk. Okay. And then, by the way, the value at risk applies to everything. It's not just options. Here, these measures really are meant for options. But next week we'll be looking at potentially any assets with our value at risk framework. All right. So I guess I'll just see you all next week then.
Good night.
Good
Bye.
night. All right. Bye.